basically in Japan and much of Europe and the United States for that matter, I think that the debt levels as they currently exist are not going to get paid back in real terms. And so, even though a number of central banks are trying to raise interest rates, especially the Fed, I think that they're not going to raise rates to the level of inflation, and that we're still going to be in a period of, for the most part, now there could be brief exceptions where they get above it, but I think for the most part, we're going to be in an environment of having rates below inflation for quite a while.
Here at Liberty in Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty in Finance. We're delighted to have this returning guest. Lyn Alden, the founder of Lyn Alden Investment Strategies, joins us this Monday, August 15th, 2022. Lyn, thanks for coming back on Liberty in Finance.
Happy to be back. Thanks for having me.
Your reputation precedes you with a lot of respect from many viewers who read your newsletter, who follow your analysis, and who just appreciate the depth of thought and seasoned perspective that you bring to a lot of the insights that you give us on what's going on with our markets. People can hear, a lot of people have opinions, but yours come with a lot of data behind them. So people appreciate that. One of the biggest themes that's emerging in our current environment, and people are wondering which way is it going to go. It feels like we're on the cusp of a balancing point, and we could tip wildly one way or the other. Maybe you'll tell us it'll be some of both. And that's about inflation and recession. We've heard a lot of talk from the Fed about, and from the president and from a lot of official sources about what the actual rate of inflation is or isn't, and whether they're making headway against it or not, and whether the measures that they're taking are going to be significant enough to make a difference or not in the face of that inflation. And then secondly, there's the counterbalancing thing that if they do too much too fast, perhaps it could accelerate what already seems like it may be beginning of a recession, and perhaps a very large one. So could you talk to us about your analysis on whether we're actually experiencing the inflation that most people are feeling in consumer prices, and whether the response by officialdom in our financial world, our monetary response, is going to be meaningful at combating that, and then what you think the impacts of that are, especially related to whether it's going to impact the depth or rate at which we fall into a recession if we are.
Yeah, so I think to the first part of that, I think the inflation's absolutely real. If anything, I think the headline numbers that we see somewhat understate the actual inflation, in large part because of the shelter component. So it's kind of a wonky way for them to calculate it. And it somewhat understates and smooths out changes in house prices compared to how it used to be calculated. And so I think, the quote unquote real inflation is probably at least in the low double digits. So, kind of a few hundred basis points higher than it is now. But of course, everyone has their own, individual inflation basket, because they all have their own, different things that they buy at a regular basis, the different weightings that they assign in their daily life. So there's no kind of one inflation metric, but I think if we were to have kind of a more consistent reading, we'd be at a slightly higher figure. That being said, we are seeing evidence of disinflation starting to materialize, meaning that inflation might be cresting and then kind of stabilizing, at least for a period of time. So you could get, disinflation doesn't mean deflation; it just means less inflation, like less rate of change. And so the way I would describe it is that the supply side remains largely unresolved. We basically have various supply side limitations, especially as it relates to energy and commodities. But there's the demand component. And by, tightening up fiscal policy, kind of in an intermediate way, and by tightening up monetary policy, they're basically taking some of the demand off. But that essentially means a recession. Another ththing that I think people have to keep in mind is that the strategic petroleum reserve is still being drawn down, and that's still expected to continue for a little while longer, and so that's putting somewhat downward pressure on oil prices. So I think right at the current time, I think we hit kind of a fever pitch in terms of inflation, and now that it's rolling over somewhat. But I think that the problem is that it's kind of like holding a beach ball underwater. It's ready to return as soon as they kind of let go of some of those levers. And of course, there's other variables too. We have to see what happens out of China, right? Because China is a huge demand source for commodities and energy, and they're showing weak economic data as well. Obviously, the one spot where there's still huge inflation risk more than anywhere else is probably Europe, because they have the most severe supply side limitations. But I think that's kind of where the data is pointing at the current time.
I wanted to pick up on one thing you mentioned there, and that was the American Strategic Petroleum Reserves. It's been fairly controversial not to have a reserve. Our channel used to be called Reluctant Preppers, and we talk a lot about preparedness. So having a reserve, an emergency reserve, is what we're all about, and we encourage every household to be as well. So for a sovereign nation to have a reserve of any critical commodity makes perfect sense. However, there's been some controversial information out there on the internet and so on, saying that U.S. is drawing down its petroleum reserves, not just to alleviate current consumer prices in the U.S., but to also send overseas. Some people even say to build up China's stockpile. It can turn into kind of trying to scratch your head and figure out what the authorities in your country, how this is serving the better needs of your people. Although we know that there is a stated agenda of the current administration to make petroleum and fossil fuels in general less affordable and less desirable, so that people rotate away, pivot into what are considered more sustainable, greener alternatives, etc. Do you have any particular insights into whether, in fact, some of these drawdown on the U.S. petroleum reserves are in fact going overseas, and whether that, in fact, is part of a intentional strategy of making fossil fuels less accessible to the U.S. so that people turn away from them to other sources?
So I think that there's reasonable criticism that they're, kind of drawing it down for political reasons, that it's not an actual crisis, and that they're basically suppressing prices leading up to the election. I think that's a reasonable criticism. Whereas, for example, what's happening in Europe is more of an actual crisis. In the United States, we have high energy prices. In Europe, they have crisis level energy prices. The other part, though, about selling it overseas, that one I think is more straightforward in the sense that, my understanding of the way that reserve works is they have, when they choose to draw it down, they have to sell to the highest bidder. And it just so happens that in some of these bids, China was the highest bidder. Now, on one hand, commodities in general, except for natural gas, because it's so the costs are so much in transportation, but certainly in oil, it's a relatively fungible market for the most part. And so if you have demand anywhere in the world, that's going to trickle through global prices. And so I still think that them selling to forwarders actually does put some downward pressure on domestic prices as well, because it's a fungible market. Now, that still could be a separate matter from whether it's a good idea to draw down the reserve or not. I think it's probably, not. But I wouldn't put them as like the motive of, say, trying to say just push down foreign prices. I also think if you look at polls, for example, if you ask people what is the biggest concern facing them, inflation will be, at the top, and then like high gasoline prices, which is another way of saying inflation, is like, number 2 or 3, and then high rent prices, which is another way of saying inflation, is also like, 2 or 3. And so I think they have a legitimate interest in pushing down energy prices in the intermediate term, because they generally want that to be reflected in how the vote goes. Because if they if they go into the election with like $7 oil across the country, I think that's going to be a lot harder for them than if they go into the election with, $3.50 oil, a gasoline, for example. So that's kind of how I'm analyzing that situation.
How about the next part of the scenario of the official response from the Fed and others in the monetary world to say that they're trying to be firm in attacking, in their response to attacking inflation? Do you think that their response is actually meaningful, and do you think it's going to have a meaningful effect, or is it just window dressing because they can't really take stronger action because of the weakness of the economy, et cetera?
So I think they can take action around the margins, and I think we're seeing that show up in the housing market, for example, how that impacts mortgage rates and things like that. This partially from private market forces, and then partially from those kind of more central forces. And I think basically they have a number of tools to kind of rein in demand. And in their view, they want to try to use them moderately. But of course, if you look at the historical track record, soft landings are rather rare in U.S. Economic history, right? Usually they tighten into a recession because during the loosening phase, they basically encourage debt accumulation, and then they tighten the screws on anyone that actually took out debt in that environment. And so I think we're seeing that play out now. We're seeing a cooling off in the housing market. We're seeing some softness in the labor force around the margins, at least. So especially when you look at initial jobless claims each week, labor force participation, job openings. Ever since March 2022, we've seen kind of a softening in there. And so I do think it'll be quote unquote effective around the margins for, temporarily reining in inflation. But I think it comes at the cost of either a significant economic slowdown or an outright recession. And I think that's kind of sort of the environment they're in now. My kind of base case is that, we've had 2 quarters in a row of, negative real GDP growth. It's a little tricky because we came off such a sugar high. And so, for example, most recessions, not all, but most recessions, they also go, negative year-over-year real GDP. We haven't hit that threshold yet. That's kind of like another arbitrary threshold. The very mild 2000s recession actually didn't quite hit that either. But so far we have not kind of reached that threshold. But I think that if this kind of trend continues, I think we can kind of trend in that direction. And you could certainly have a kind of like a double dip recession where you have, say, 2 negative quarters and then a slightly positive quarter and then another negative quarter. And you can kind of bounce along this weak path. But so far the data is still deteriorating. Basically rate of change data is still showing overall kind of weakening prospects. When you look at PMIs, when you look at producer prices paid, basically we're seeing a disinflationary impulse, but not really for good reasons. More so due to the demand destruction rather than the supply constraints easing.
For people who've been riding a very long bull market, some people say 40 years, of not only stocks, bonds, real estate, and we have with the baby boom generation aging, ending their working career, late career stage, starting retirement, trying to start retirement, hoping they can start retirement. There's significant concern on many people's parts is what do they do if the baby boomers all exit the market at the same time, in the same, time that the markets are already showing some softness as you're describing. Do you have any thoughts about the impact of this generational demographics on what's going to be going on for the next several years in the markets?
So I think that'll be a multi-year story. I don't think that's going to be kind of a price driver in any kind of one single quarter. But I do think that that's going to be a pressure, a negative pressure that was not there in the prior stage of demographics. Another thing I'm looking at is, at the end of 2021, if you look at stock market capitalization to GDP, it got up to around 200%. If you look at, for example, the Wilshire 5,000 compared to GDP, and that was a record high when it reached that level. And you had a combination of interest rates were driven down super low. You flooded the market with stimulus, and I think that was probably a high watermark that we're not going to see for quite a while. And that doesn't actually mean that the stock market can't hit nominal new highs, but I do think that the stock market relative to GDP has probably hit kind of pretty structural highs. It's hard to envision a set of forces kind of bring that up again, because that was kind of the culmination of 4 decades of falling interest rates all the way down to zero, and then you had that absolutely huge kind of fiscal and monetary impulse together. It was kind of the end of a long-term disinflationary cycle. You had oil go negative, so there's no at the time there was no pressure from commodities until kind of the end of the year, and so I think that's a risk I'm looking at, is that whether or not we hit nominal new highs, I think that forward, say 5 to 10 year returns for the S&P 500 in inflation adjusted returns are going to not be great going forward, because I think we're in more of that kind of sideways band going forward.
We have a question here that relates to this demographic question specifically for Europe, though. The Klaus 3001 asks, demographics in Europe are horrible. How will they pay the debt with a shrinking workforce? And it's true, they're well below replacement rate, and I think in every European country at the moment.
Yeah, we see that especially problematic in Italy because you have a over 150% debt to GDP, and they have a labor force that's like I think declining as fast or faster than Japan. Um, and so I think basically in Japan and much of Europe and the United States for that matter, I think that the debt levels as they currently exist are not going to get paid back in real terms. And so even though a number of central banks are trying to raise interest rates, especially the Fed, I think that they're not going to raise rates to the level of inflation, and that we're still going to be in a period of, for the most part, now there could be brief exceptions where they get above it, but I think for the most part, we're going to be in an environment of having rates below inflation for quite a while. Especially on the short end, and probably also inclusive of the longer end. And so I think that part of the way that gets handled is through all the owners taking a haircut in real terms and basically losing purchasing power by holding that debt long term. I mean, they can still get trading opportunities out of it as interest rates go up and down. They can get price appreciation if they trade it well. But I think as a long-term holder perspective, I don't think sovereign debt in developed markets is the place to be for quite a while.
Yeah, Rick Rule, tongue-in-cheek, refers to that as return-free risk. That it's just crazy when all you can get is a negative real return from sovereign debt, basically anywhere in the world. Speaking of geopolitical risks, Mike asks, what leverage does China have given that they own trillions in U.S. debt? Would it be enough to deter the U.S. from engaging in a Taiwan conflict? When I say mentioning geopolitical, you talked about the stress, the real energy crisis in Europe, and I assume the reference was to that Russia holds the handle to the faucet that can be turned off, and they'd have no natural gas to make it through the winter kind of thing.
Yeah, I mean, the issue with Europe is that, I mean, if you look at their natural gas price, it went vertical even before the war, kind of the end of 2021 period. And it's gotten worse since then because obviously now there's a lot of geopolitical risk. Basically, they were very, very reliant on Russian gas, both for heating and for electricity generation, and all sorts of inputs for things. And that's a big pressure now. And one of the ways that they alleviate that, they can get some more LNG, they can burn more coal. They can, reverse some of their nuclear plant closings and things like that. But some of those actions push up prices for the rest of the world, right? Because if they're getting more LNG shipments, that means less gas for other places. Basically, there's people that are naturally arbitraging that, and then the fact that if they end up burning oil and coal, which is what they're doing now, that also puts upward pressure on prices. When we look at China's leverage, I wouldn't describe their trillion. They have roughly $1 trillion in U.S. Treasuries, more or less. We can remember that back in March 2020, during the COVID crash, there was an issue where foreigners started selling treasuries, so the treasury market broke alongside the stock market, which was unusual because normally when the stock market's going down that much, people flee into the relative safe haven of treasuries. And at first, people were doing that until it got so bad that the foreign sector and risk parity funds had to kind of unwind in a disorderly way. And when that happened, the Fed came in and bought $1 trillion of treasuries in 3 weeks. They ended up doing multiple trillions of dollars in total QE. And so compared to China's, ability to sell up to $1 trillion in treasuries, I think that's something that could be absorbed. But I think that there are much bigger risks, between these two countries. One is that much like how Russia had their reserves, frozen, China is actually vulnerable to having their reserves frozen. So that's a risk on their side. A risk on our side is that China can, nationalize a lot of our companies' manufacturing facilities or otherwise cut us off. And that's a much bigger problem than just selling, half or all of their treasury stash in kind of a disorderly way. I think Luke Groban described it well, a fellow analyst. He pointed out that, Lehman was like a $600 billion balance sheet, whereas China, it's like a multiple tens of trillions of dollar balance sheet. So basically the interlinkage between these two countries is so great that they have very significant ways to hurt each other, even more so than some of the ways that, Russia and Europe, for example, have ways to hurt each other.
You mentioned earlier there that the flight to bonds during the COVID crisis caused instability in the market itself. There's a related question to that from Crypto J, who says, how high can the dollar rally before it causes global instability in emerging markets?
So it's partially how high it goes, and it's also partially the speed with which it gets there, right? So if the dollar kind of grinds up slowly over time, it can get to a higher level without breaking things compared to if it just shoots straight up, which is what it did during that COVID crash. That's what triggered the foreign sector having to sell it because, if you look at foreign balance sheets, they have something like $13 trillion in dollar denominated debt, according to the Bank for International Settlements. That's mostly not owed to the U.S. It's like owed to other foreign entities. So countries in Africa owe China. Countries in South America and Turkey, they might owe European entities, right? It varies across the world, but it's denominated in dollars. And so if you have a situation where dollar-based cash flows are drying up while they still have all that debt, they have a problem. But one of the things that they can do is, the foreign sector has tens of trillions of dollars worth of U.S. assets. That includes stocks, treasuries, corporate bonds, and less liquid U.S. real estate. And so the entities that have those types of assets can sell those assets if they ever need dollars. And that's what we saw in that kind of March 2020 environment. And obviously some emerging markets are in better shape than others. So for example, Turkey's in a very rough spot because they have liabilities that exceed their assets in terms of international reserves. Whereas when you look at, a country like Brazil, they're in somewhat better shape, for example, and so they have more options available to defend their currency. We're also seeing, if you look at the dollar index, as strong as it has been lately, it's actually been more a factor of how weak the euro and the yen are. If you look at the dollar compared to a lot of other major currencies, it's been strengthening, but in many cases it's still below the highs it reached in 2020. Whereas, when you compare it to the euro or yen, that's a different story. It's kind of broken out against those. So I think that this particular dollar rally has not been as vicious on emerging markets as it could have been. But if it keeps grinding up, and especially if it goes up in a disorderly, quick way, that can absolutely put pressure on, especially the weaker emerging markets, the ones that have more debt than they have, international reserves. So Turkey's at risk, Chile's at risk. Argentina's at risk. Basically, there are a lot of these periphery countries. Whereas I think, other countries like China, Brazil, and places like that, they have somewhat more resiliency because they have significant reserves to offset their liabilities.
The next question, I'll couch it with the disclaimer that we do not give personalized financial advice on our channel. Neither do we ask our guests to give personalized financial advice, but we're talking about the principles involved here. Batman Gilhich as how long can we expect the stock bear market to continue, and how deep can we expect stocks to go down? Should a long-term holder take advantage of the recent bounce in stocks to sell all the decade-long such holdings and go onto the cash on the sidelines until the end of the bear?
Well, I think so. There's always a challenge in trying to determine tops and bottoms for anyone. I generally use kind of a dial in and dial out approach, meaning that, if the market goes down significantly and sentiment turns very bearish and valuations improve, I generally put a little bit more chips on the table. I buy a little bit more equities. On the other hand, if we see, a huge rally and kind of a euphoric peak, I trim some of my equities and get a little bit more defensive. And it's not necessarily that I'm trying to time the top or bottom specifically, but it's rather that I'm just risk managing and kind of allocating around the margins. And so the first half of this decline was mainly valuations. So earnings were still holding up well, but as interest rates rose very quickly, we saw downward pressure on a lot of valuations for different equities. The second half of the year, I think the bigger risk is the earnings side. And so we've seen somewhat of a relief rally here as forward expectations of interest rates have cooled off. So that takes some of the pressure off of the valuation changes. But I think the key risk to watch going forward is earnings weakness. And I'm very kind of sector dependent. And so, for example, I think that there are energy pipelines, there are healthcare stocks, there are value-oriented, dividend-oriented equities out there that are trading at average or historically below average valuations, even as the broad market is rather expensive. And so I think it comes down to, it could come down to individual stock selection or sector focus. Basically, I do think there are opportunities out there, but I think that I'm kind of modeling this more like a wide band of volatility rather than kind of a just a steep fall, right? Because we still have high inflation, we still have negative real interest rates, so it makes it challenging for investors to get too focused on bonds and cash. But I do think that there is another risk of another leg lower, specifically from the earnings side. So that's what I would watch is signs of earnings deterioration from major companies.
So, on the other part of the question about keeping some powder dry, what's your philosophy about that in general, and how do you apply that in the current environment?
Yeah, so I always have some cash equivalents and kind of those types of defensive assets. And like I said before, I kind of dial in it and dial it out a little bit based on market conditions. So I never go all to cash. I never drop my cash to zero. But instead, if we have like if equities are down 20%, and then there's some kind of particular names that are down 40, 50%, but I think that are high quality, I then might take some of my cash and just kind of lean in a little bit to some of those things that fell quite a bit. I've done a little bit of that this year. Whereas when you see the opposite, when you see like a huge euphoric spike, I try to use that opportunity to take a couple chips off the table and build up my cash levels a little bit. So it's less about trading and it's more about rebalancing and position management and kind of leaning in a slightly contrarian way, kind of the opposite of what the market's doing.
Again, I'm going to circle back to energy in Europe because we didn't really talk about the impacts of that on the people and on the financial and then potentially global impacts as well. TP Bop says, how do you think the energy crisis in Europe is going to play out this fall and winter, and what ripple effects may this have on U.S. markets?
So it's really challenging because there's human decisions involved, right? So that partially how it plays out, it depends on what Putin does, and then it also depends on what European leaders do. But I think in general, they're going to resort to more diversified energy sources, burning more coal, burning oil for electrical energy, which is generally not what you want to be doing, but it's something you can do in an emergency, and getting more LNG, and so that can put higher pressure over time on energy prices globally. I mean, if they're basically buying oil to try to fill some of the gap they have from natural gas, that puts upward pressure on global oil markets, and they're more fungible than natural gas. One of the reasons that natural gas can get such crazy prices over in Europe is because, unlike many other commodities, it's not very fungible. So, things like copper and oil are their prices vary somewhat around the world, but it's actually a pretty narrow band for the most part because it's usually not that hard to ship those things to where they need to be. Natural gas is a lot more challenging because in order to transport it long distances, you either need a pipeline, which obviously requires years of construction and a lot of capital expenditure and needs to be over land usually, or they can do LNG, liquefied natural gas. But the problem there is that the fleet is only so big, and the facilities that are required, it's a very complicated process. You have to hypercool it, and liquefy it, transport it, and then reverse the process. And that's a very expensive and limited capacity thing to do. So there's only so much LNG available at any given time, and so it's actually much harder to kind of close these price gaps for natural gas compared to just about any other commodity. And so I think that the basically the upward pressure that they're going to do is that by resorting to other commodities, especially oil and coal, it puts pressure on those markets. So I think it kind of ripples through the whole world in that sense.
Do you personally, just this is an opinion question, do you personally foresee any humanitarian crisis emerging this year in this winter, or is it too hard to call because of those human variables that you mentioned earlier?
So I think it's well telegraphed that there absolutely could be, right? And so, we're hoping basically they make as much preparations as possible to minimize that. It shouldn't come as a shock to anyone if it does happen. But to the extent that it does happen, does unfortunately largely come down to human decisions. There are basically a handful of players here, as well as just the temperature of the season, and how much natural gas is needed. Those variables could have a huge variance on whether there actually is one materializing or not. But the risk for it is huge. Compared to what we're seeing in Japan, compared to what we're seeing in the United States, the energy side of Europe is one of the more alarming situations globally.
Back to the major theme we've been talking about pretty much the whole time about inflation. Jack Robert asks, are we in a stagflationary recession environment, and will the new so-called Inflation Reduction Act coming out of Congress really reduce inflation?
So stagflation, means low or negative growth while you have pretty high inflation. And I think it's pretty clear we've been in that environment. We've had 2 quarters of negative real GDP growth while we've had, high single digit official headline CPI, let alone what the real numbers are. And basically stagflation is supply driven inflation. So it's when, inflation's happening not due to overwhelming demand, but due to, scarcity of the supply side. So I do think we're in kind of an ongoing stagflationary type of problem until we bring on, more energy supplies. I think the Inflation Reduction Act, I mean, if that same bill was passed in any other environment, it would have had a different name. So I think that a lot of that was branding. I think that there's been some analysis on it that shows that it shouldn't really impact inflation too much. It's mostly it rearranges some of the tax things, and then it also it obviously puts some money towards energy. But I think that to the extent that it impacts various things, I don't think inflation is one of the things it has a huge impact on. Maybe around the margins. I think there are some areas it could raise inflation for, other areas it could reduce inflation for. But the combination of the size of it and what it focuses on is just not it's not a huge variable for how I'm modeling forward inflation.
Do you see the monetary or economic impacts of it being actually inflationary themselves? So you just say you don't think it's going to have a significant impact one way or the other?
So these should take time to get out into the market, and so it's not the same thing as like when we had $1 trillion worth of stimulus checks going out in a short period of time. So I don't really see this impacting on a kind of a quarter by quarter basis how I view things going forward. If there were like a bill to like bring on some new nuclear plants or basically fix the energy supply side a little bit more, that could be impactful. And that's actually there is a nuclear component in the bill that I think is constructive. I mean there are parts I'd probably agree or disagree with around the margins as far as the bill is concerned, but I think that especially in the near term, I kind of view it as a non-variable for forward inflation expectations. But on the longer term, it does affect how certain investments are going to perform because it changes their tax implications somewhat. More people will be audited, so that'll certainly impact the people that are audited because it's more IRS agents. So there are certainly pockets where it'll affect things very significantly. But I think in the broad sense, it's not a huge variable for kind of my inflation modeling.
You made me crack up when you said that in any other environment it would have been called something else. There's a couple of principles around that. One is that most major bills coming out of Congress in the last several decades, you could pretty much figure out what their real effect is going to be by taking the opposite of whatever the name of them are. But the other one made me remember a joke about a customer in a diner, and the waitress has got a glass coffee pot ready to refill, and the customer said, "Wait a minute, is that decaf?" She says, "What do you want?" He said, "Decaf." She says, "Then it's decaf," and pours it on there. So, what do you want it to be called? That's what we're selling. In the face of all of this uncertainty, many people are seeking safe haven in real assets such as precious metals, that sort of thing. If you could give us your personal view of the role that diversification into tangibles should play in people's portfolios in times such as this.
So I think precious metals give people a handful of benefits. One is that it's somewhat uncorrelated with stocks and bonds. You can have an environment where both stocks and bonds do rather poorly and gold holds up pretty well. The beginning of the year, certainly we saw that kind of gold was holding up better than stocks and bonds at first. Then it took a little bit of a tumble. It's also a decent hedge against persistently negative real yields. And so, right now it's obviously been pressured by the rising dollar and the Fed tightening policy so much. But when the market starts to sniff out that they're getting to the top of their, potential tightening range, I think that can buoy gold specifically. And if you go back to what I said before about the valuations versus the earnings in the stock market, so when the stock market's being pressured on the valuation side due to tighter monetary policy, we're more likely to see everything correlated. So gold going down, stocks going down, these things, kind of all happening together. But then if you specifically get into the next stage of that, where it's less about Fed hawkishness and it's more about earnings weakness, then an asset that doesn't have earnings, gold, can potentially decouple from equities in that type of environment. That's what we saw in the 1970s. That's what we saw in the 2000s. Basically, in that kind of stagflation environment, when the weakness in equities is driven by the earnings side, that's when kind of this uncorrelated asset can do well. And then, of course, the other main benefit is that you get outside money. So there are relatively few assets that you can self-custody that represent, portable money-like value, right? Because when you hold stocks and bonds, in cash, it's basically it's held on custodianship for you. It's an IOU essentially. Your real estate, obviously, you can hold, but it's not portable in any sort of way. And so things like gold, silver, or maybe Bitcoin, these represent these self-custodial ways of people holding value that is outside of any sort of IOU based system. And so that's obviously valuable for a lot of people throughout the world, I think.
This is kind of a interesting question. It's very specific, and it's within this realm of gold and silver. A question comes from Maxime Augustin, who says, is jewelry money to you? And should we count it with or without markups?
So it's certainly money in India, for starters. That there's a long tradition of gold jewelry being a store of value in India. In the United States, we see, I don't extensively use jewelry as money, but I can certainly see why people do. And there's even services now that are targeting that. I believe that one is called Mene, right? So you can get 24 karat jewelry. And so it's basically, it's designed to have less of a markup and to be, to more closely resemble the actual gold content than you would get in more complex jewelry or in more resilient types of jewelry. And so I think that, services like that are interesting. It's actually also, one of the kind of funny ways that it's a way to get, gold through airports and stuff, right? Because, if you're trying to bring like, coins and bars, you can potentially run into more issue than if you're wearing it. And that can apply to a lot of different countries in the world. Obviously, they're all going to have different laws, or regardless of what the laws are, just whether or not you get stopped. Just you're just wearing a necklace. And so I do think that there is a use case for that type of approach. I just think going back to what you said, I'd just be cautious about the level of markup you pay and whether or not it's kind of the type of jewelry that is more tailored towards store value or is more tailored to being highly decorative and having a very large markup.
Lyn, if people want to stay plugged in to your thoughts on a weekly basis and stay attuned to where you see things heading, as a lot of volatility, a lot of those human decisions are being made by actors that really can sway things one way or the other, how can they get connected?
So I'm available at lynalden.com. I have a lot of free content as well as some paid content. I'm also active on Twitter at Lyn Alden Contact.
Well, we're grateful as always for your presence here on Liberty and Finance. And so on behalf of all of our viewers, just thank you for joining us.
Thanks for having me.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.